All right, so the midterm elections came and went. We've got it behind us now, and you can see how much the market likes having the midterm elections, having that question mark resolved. So now the question is, how much more do we have left to go? Where else can it go from here, considering how much we've rallied, how big was this rally? Also, what's going to drive this next leg higher? We've seen what's driven so far. What's going to drive the next leg higher, and how long can we expect this next leg to last? That's what I break down in today's video with the trade idea in a strong, with a stock that's showing a nice, strong, bullish price pattern on its chart. So let's go ahead and get started. Today is Wednesday, November the 7th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get right to it and take a look at the S&P 500 with the market forecast indicator. And you can see, whoa, a big blast on through to 2813 to 2814 today. So nice post-midterm election rally that's been hanging in the air for a while. You can see the market was relatively optimistic heading into it after this decline. In fact, if you notice, we've recovered now all of the losses from the second leg. So we had the first initial surge where volatility really went up to an extreme. Then we had the second surge down to a new low where volatility did not jump up to quite the extreme levels, but went to a divergent low point. We've now hit the target of the divergent low point. So we targeted this area. We've now hit that target. And if you notice, we've hit that target in 1, 2, 3, 4, 5, 6, 7 days, and recovered in 7 days in losses that we've incurred in 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So much for falling off the cliff, falling out the window and walking up the stairs, right? Well, we fell out the window, hit the trampoline on the ground, and jumped right back in through the window. Just like that, right? So that happens. That just shows, that happens with divergent low points quite a bit. That's why you target this area. That just shows that was a lot of fluff here. This kind of late selling was, it was too extreme. You suckered in a lot of the bears that just want the market to go down for the sake of going down. And now we've, it's hard for them to sustain the market for too long. Now, that doesn't mean we'll never have a bear market, right? But bear markets don't start with extreme. We don't fall out the window at the close to 52-week highs. We fall out the window as you saw in 2003, 2002 at the end, in 2008. We fall out the window at the end of bear markets. That's when we really fall off the cliff, and that sets the low point. So we will grind our way more to bear markets over longer periods of time before we get those kind of really extreme 4% moves on the ATR. So you can see the intermediate line's rising. It's not above 50 yet, but the near-term line is now way up in the upper reversal zone and kind of shows just how bullish this move has been. And it's 7 days now. So we count the 7 days. We talked about the idea that there would only be like a 3 to 5 day move before we got to pull back on the near-term line. Well, it didn't quite get below 50. And so as a result, we're adding on this new rally, and this is looking very similar to the October 2014 bounce off of those extreme lows here. So there's your 2014 extreme lows that we had clusters on, long lower shadow to new lows that nobody wanted to buy on at the low point of 1015, and just in a matter of days we recover all those losses and then some. Right, and we get a overbought cluster, and the near-term line stayed above 50. See, we had the pullback right there, but it didn't come down far enough, just like it did now. And then we stayed up above 50 for multiple weeks. And again, this is the last midterm election too. Now it's a little bit later. See, we're a lot closer we're about in this area right now. So we've rallied a lot quicker in 2014 than we did now. But you get the idea. That's we're looking more like that pattern. Here with how bullish the near-term line is. Good chance that it will run its course, the typical course of 7 to 12 days, if not longer, with the intermediate line crossing above 50 and now starting a new. See, when the intermediate line crosses above 50, it starts a new intermediate run that's expected to last 1 to 3 months. So we'll keep our eyes out on that. And you can see the momentum line kind of flat, but that's a lot of that has to do with the gap that we had today. Otherwise, it would have jumped up higher, especially considering The momentum line includes the range that you don't see today because of the gap, right? If we would have had that range included, the gap here from yesterday's close, so the overnight trading, then the momentum line most likely would have been up there too. Given how bullish we've been, how big the range was today, 40 points, not including the gap. See the gap here, we closed at 27.55 yesterday. Today's low point is 27.55. Today's low point is 27.74. So it's a 20-point gap. So we had if you include the overnight trading, we had a 61-point range with an average 45. So that usually means the momentum line, especially closing at the high, the momentum line would have been up higher. So the market sentiment's fallen below 50 like it did over here. So that tells us, again, good chance that we'll get a new market sentiment. We'll get multiple intermediate rallies. This would be the first one once you cross above 50. And like we did over here, we got two on this one that lasted almost 6 months. And so we would expect multiple intermediate rallies to come out of here that would last 6 to 9 months. And you can see all the other indexes look very similar. The Dow has blown through that equivalent high point at 2,800 for the S&P 500. Big time move on the Dow. The NASDAQ has not. It did get above its moving average. Has not quite gotten to that same level. It's been a little weaker, so its short-term sentiment's not as strong. And then the Russell 2000 also not quite up to that level, but still looks very similar to the S&P. And you can see its momentum line did get higher because the lack of a gap on this chart. It had been more bearish because of all of these clusters, so it's got a much longer way to run to grow off of this than the S&P did. All right, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your screen, then click the red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us that you like the video today, you want us to keep doing it. Comment further down below on anything that stands out to you from tonight's video. What did you get out of it? What questions do you have from it? Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Also, follow me on Twitter for more content like this throughout the day, and join our Market Outlook community that we created on Facebook. You can join our Market Scholars community on the website here when you're watching our video, right above to the top right, above the calendar for our classes. You'll see a little image there to subscribe to our site. You can do that for free. When you subscribe, you can participate in our forums with all of our other Market Scholars community there. Be able to talk about tonight's market outlook with other people that watch this day after day. Remember, if you want us to keep doing these videos, we look for 3 clicks. Click number 1 right here on this like button that opens up a new window. Like tonight's market outlook tweet. Also click this Facebook image, takes you to your Facebook page where you can like the tonight's market outlook Facebook post. And then thirdly, click on this like button here on our blog. Those 3 clicks tell us you want us to do the video again tomorrow. Really easy way to give us feedback. All right, back to the chart, and you can see, whoa, we've blown. Now, granted, this is a weekly chart, and we got 2 more days left in the week. And the Fed's meeting today. The Fed's not going to do anything today. Right, they're not going to raise rates. Most likely. They can do anything, but the market's not pricing in a rate hike from this meeting. In fact, it's almost kind of like non-news right now that the Fed is meeting here, because simply they don't have a press conference and they usually don't do anything. And now that won't be the case starting in January. January they will have press conferences at every meeting that they have, not just the quarterly meetings where they usually have been announcing their rate hikes. You notice on the week though, with 2 days left, we are back up above not only the 200-day moving average, but also back above the 50-day moving average. So again, the fact that we dropped below the 200 in 1 week and got back above it the next week with a long lower shadow, very bullish sign that so far is playing out on the weekly chart. The MACD is rising. I would not expect the MACD to get above that high, right? It usually starts to grind its way towards zero for over months. We peaked in earlier this year. I expect us to grind our way towards for the next 6 months to 9 months with ups and downs on this long-term MACD line as we kind of move our way upwards. Maybe not to the same extent as we saw right here, but remember the last time that the international stocks were so bearish compared to U.S. stocks was back at the beginning of 2016, and when the dollar started to weaken a little bit at the end of its bullish run, then we've had 2 years of really good equity returns that were paced by international stocks. So we are as bearish now on those stocks, again, relative to the S&P, as we were back here, right, in early 2016. Not saying that we're going to get an exact replica of this, because this also is fueled by an election here, the national election. Just saying that the environment is leaning more towards the upside, and it would basically help continue this grind. That would be a little bit higher because the highs are a lot higher. These two highs are higher than the biggest high that we had in 2013, 2014, when we started the decline before ultimately bottoming out at the end of 2015 below the 200-day moving average. All right, so look at you can see the Dow Jones back easily above its 50-day moving average. NASDAQ above its 200 again, long lower shadow, almost above its 50. And the Russell 2000 again had further down to go, but has close to getting above both its 50 and 200-day moving averages as well. Again, see how we finish off the week. If you take a look at the 3 green arrow chart, 3 green arrows in the MACD, you'll see when you break down those lines, so we blew through the 17-day moving average here, and let me get rid of this Fibonacci retracement. We blew through the 17-day moving average yesterday in anticipation of this election, but we didn't get above that high, so it wasn't as bullish. But today, really bullish. MACD, as I mentioned before, the MACD usually will converge to the upside really quickly. It doesn't have to bust through to now. In October 2014, it did get to like an extreme high point coming off of an extreme low point. That usually doesn't happen. But again, the last time we had midterm elections, it did. Coming off of an extreme drop in October towards the end of the year. The stochastic's also above its moving average. MACD crossing above the green, crossing above the red, there the 8-day crossing above the 17 is what brings this blue line above zero. Once the 8 and the 17 both cross a 30, then we've solidified that reversal. So we still got a little bit of room to go there. So that opens up for near-term pullbacks, but not necessarily trend-changing near-term pullbacks. All right, now let's take a look at the intraday moves, and you can see about as bullish of a day as you can get. The low of the day early, the high of the day late. See, usually when we gap up strongly, the high of the day is early. So the fact that we rallied up through the rest of the day is so bullish. And we got into the upper half of the chart really easily. You can see we're hitting some short-term resistance here, but we're getting up in the upper half of the chart really easily. You also see that short-term resistance playing up in the volume chart for this past year. We're right at the 70%, the top end of the 70% channel. That's going to act as a resistance. You have a couple more volume nodes here and here that will also act as a resistance before you potentially make your way up to higher levels. But going back to this chart, you can see you also have a long upper shadow. The purple line is this week's open on the Heikin-Ashi candle. So the Heikin-Ashis have really turned around and look a lot more bullish now. That's kind of halted the bearish trend. You can see the long upper shadow, very, very minimal lower shadow. So a good sign from that regard. And also, too, we're up above last week's high point. So we haven't traded above the high of the previous week in a while. So all bullish kind of breakouts there. Above last week's high, above the Heikin-Ashi open, which we haven't traded above in weeks, and into the upper half of the chart, which we haven't been above in weeks. And that upper half of the chart is going to really come down tomorrow. See, tomorrow the high point is going to drop to this level, right to where we're at. So just like that, we have gone from an extreme 10+% range in 4 weeks, which is extreme, to trading at the 4-week high just like that, right? Because of the high pulling back and because of this bounce. So big change in sentiment Monday in the afternoon. We talked about how bullish that was to get such an extreme. When the bears are the loudest, when they growl the most, then and the market gets really one-sided. These are the kind of moves you get out of it. All right, if we take a look at the range today, SPY here, you'll see that, remember, if you add on the gap here, which was about 2 points, you see the close at 275.12, and then today's low at 277. Oh wait, so you had about 2 points. So you had about a 6-point move today. So above average move, but about 100 million shares traded, trading hands. So you put that in context. 100 million shares is well below the average. 6 points is above the average, but I mean, this is kind of a breakout move. It was a big risk event that we had that we've been waiting for, that we finally got behind us, this midterm election. So we had above, I mean, that's well above 2% on the ATR, but don't expect moves like this anymore, right? You know, we'll start to really bring these lines down again, just like we did in October 2014. You can see volatility is also a lot lower now, having dropped below to lower lows, coming down from a lower high. You can see that here better. So, you know, lower lows from a lower high on these oscillators in the hourly chart. So on a relative basis, it's brought us below 95%. There still is going to be some near-term support for volatility at this 90% mark, as I mentioned to you before. But when you break 90, that's when, okay, now we are in this moderating volatility cycle. So 15 will act as a support on the way down, just like this 90% will. You break below 15, you break below 90, now we're going to be bullish for a while. So watch for some near-term support for volatility, so near-term resistance for stocks as we approach those levels. But again, just near-term, right? Just short-term resistance, short-term weakness, not trend changing. Where the trend is now establishing itself as bullish, but just because you're bullish doesn't mean you're going to go up every day. You're going to get some near-term pullbacks, and you can see where and why we'll get potentially our next one. All right, so to summarize, the markets have really been bullish today. The posture is changing. We're starting a new intermediate run. We haven't started it yet. It hasn't got above 50, but we're close to starting a new intermediate run, which would be the first of a potentially 6 to 9 month long-term run. It won't be without its near-term pullbacks, especially here early with volatility still relatively elevated. So expect that, but you know, again, I was expecting more of a near-term pullback here this week, especially a knee-jerk reaction with this election. But the knee-jerk reaction lasted all of, you know, 10, 15 minutes last night during a pullback, and the market has rallied since. So usually when I'm wrong on the markets, it's because the markets end up being more bullish than I expect, and that's been the case here. So what do you think? What do you agree with this outlook? Do you disagree? Click the link popping out in the top right corner of your screen. Opens up the poll, and then click either agree or disagree. Scroll down to the bottom if you disagree, and comment on what you're seeing that would suggest otherwise. Again, not just your opinions, but I want, you know, if you see something, a chart or an indicator that would suggest did something different than what we've outlined here with our market posture routine, we definitely share that with our market scholars and market outlook community. All right, so in terms of what's driving the price action, let's focus there now, and you can see not exactly a big news day. Of course, the biggest news was not an economic calendar or an earnings announcement. It was the Duke-Kentucky college basketball game where Duke just utterly destroyed Kentucky by 30 points with the new Fab Five. But no, the reality is, I mean, that was all expected, right? It was the midterm elections that drove the market reaction here today. I'll be able to see how many of you actually watch these videos through if you catch that reference midway through our video here. But you can see what happens after the midterm. The S&P took off. It was the best performing asset class today. Small cap stocks lagging behind, but still better than international stocks. There's EEM, also really, really good bounce. There's your developed markets lagging behind the most. High yield did really well today. The dollar was down. So you can see some of these others. Long-term bonds actually started the day very strongly. So a drop in yields. But then, of course, with risk appetite, man, long-term bonds really dropped. And then crude oil, incidentally enough, down today. Of course, that was the one thing on the economic calendar here was the petroleum report status. You can see more inventory putting some pressure with rising inventories, putting pressure on prices there. So the news today, of course, economic indicators are looking better. They're not strong, too strong, but at least they're not bearish either. We never did really get that sharp decline that usually coincides with these big drops in yields and big drop in stock prices potentially, right? So we haven't really got that here. So you can see that the economic indicators are improving. If you look at the rate hike odds for March, right? So December still looks really strong, but March you can see you have You know, pretty decent. You still have pretty decent odds, almost 50-50 of getting another rate hike in March, though getting above 60 is what really solidifies it, and we haven't done that yet. And you still have for the next quarter, for Q4, initially very strong economic growth. Expect that to come down a little bit as we get more data. That usually is what happens with this. The question is, how far down will it come as we do fall? So again, going back to this chart, look at growth stocks leading the way. Very broad-based rally. Even if it did lag, it's still, you know, they all still rally. There's your value stocks and alternative stocks, all the dividend players. So really broad-based rally in stocks. On the other end, just commodities with the drop in crude oil, which was very driven by just one particular indicator. The dollar coming down. As the dollar continues to come down, we know how to play that. International stocks will do really well. And sector rotation. We already know the sector rotation that will come out of that too. As I mentioned in previous videos, this bounce off of these lows will be led by these higher beta industries. You can see healthcare had a really good day today, but there's technology and consumer discretionary rallying. Communication services started the day strong, but they lagged behind by the end of the day. And then there's materials, energy, and industrials. If you look at how the market has moved from the low point on Monday, so let's just refresh that and make sure we get to the end of the day here. From that point, so from the point where nobody wanted to buy stocks late Monday of last week till now, materials is actually your best performer, up 10.5%. And then there's consumer discretionary almost up 10%. Industrials is up there. And then energy up 8%. So your biggest winners were your biggest losers. And these are expected to be the biggest winners over the course, you know, as the market, you know, you can see if I were to go back to the very beginning of the year when we really peaked in the stock market here in late January. So from this point going forward, you can see industrials, materials, and energy were the biggest losers by far. They were down, you know, 15% on energy and industrials and 20% on materials. Financials also struggling too, there in red. So they were your biggest losers because they do poorly when the dollar rallies. International stocks lag, so do these sectors. But you can see that they've started to bounce the most. Interestingly enough, from the very worst point you could have bought stocks in January, at the very, very tippy top, utilities are up 10% from that point. so that, and you can see most of these other sectors, technology, discretionary, are up from that point as well. Same thing with real estate. So real estate and utilities up 5 to 10% from the very worst day in January that you could have bought stocks, the highest point there. But like I said, you know, with technology and discretionary and communication services, your FANG stocks, they will lead this bounce, the initial surge. But eventually you would expect if the dollar were to roll over more, international stocks start to outperform, as we've talked about, then these energy, materials, and industrial sectors would be, they would take the baton and start leading the way higher from there. All right, so for our trade idea of the day, one stock that has a really good little breakout move here off this little kind of wedge pattern is Pfizer. A nice good breakout move today into the upper half of the, up above the moving average within the Bollinger Bands. See, not a lot of volume. This was the breakout move. Not a lot of volume resistance in this area, not nearly as much as there are down in this area for this past year. So a pretty good move from there. You can see the DMI for Pfizer if I pull up Pfizer here. The MACD, the positive and negative lines are right at zero, so close to a crossover, which means there's a good opportunity for a breakout move to occur that would last a little bit longer than what you would expect. Good volume move there today. You can also see on the 3 green arrow chart for Pfizer, you're back up above the 30-day moving average, the 8-day close to crossing the 17, MACD crossing above its moving average, stochastics getting above 50. You look at the market forecast indicator, something similar here for Pfizer, that the intermediate line never did get extremely low. It's turned up, close to crossing above 50 itself. It would look better if we got it's that dividend payment here that's going to be coming out tomorrow. That's going to impact this a little bit. But so it would look better if that near-term line were up here above 80. Not quite there yet, but still a good breakout on the price pattern. So, and like I said, with the DMI having both lines below 0, below 20, excuse me, that opens up the possibility for an extended move. One where you can say, okay, if I were to buy, go out 50 days, or at least as close to 50 as we can, and buy this at the money December, and I can go out a little bit further if I want. I can go to January and buy this at the money option. Actually, this one is our at the money option. The 44 option's got the most extrinsic value. If you take a look, Pfizer, here, let me go to single symbol, and let's analyze that trade, and we'll go out to January. You can see by January there's an opportunity for the stock to get up to 48. That would be up into this area. Again, more of an extended move, similar to this move that preceded the wedge. So, at current volatility levels, if you did get up to 48 by January, there we go, 48, and then it would be a move of $3.60. This $1.53 call will be worth $4. So you'll get about a $2.50 gain, almost a 2-to-1 reward to risk ratio. And if you got there quicker, then you would get that 2-to-1 reward to risk ratio on a long call, a swing trade, short-term speculative directional move. So you position size for half of that loss. So put your stop order at half of that $1.50, position size around that with a smaller position than normal, because this is a lower probability trade. Buying calls is a lower probability than vertical spreads. But you have a good opportunity here given the price pattern and other technical indicators that suggest there's a lot of upside potential, especially, again, considering the broad market and everything else going into the equity. So, the rising tide lift all boats phenomenon. All right, so that wraps us up for today. Now I want to hear from you. Click that link that's popping out in the top right corner. Let's go to the forums on marketscholars.com and discuss tonight's market outlook and what's going on in the markets today. Any questions or comments you have for me on what I talked about or anything I didn't talk about, or if you see something you want to share with other market scholars, let's do that in the forums. As always, thank you very much for watching. Remember, to participate in the forums, you can subscribe to our site for free and join this great community, like over 1,000 people in the community, very active on social media in our forums. So make sure you come and share with this great active and vibrant community. Again, thank you for watching. Have a great rest of your evening, everybody. Subscribe to our YouTube channel. Click the thumbs up icon and comment down below. Follow me on Twitter and join our Facebook group that we created for the Market Outlook video. We'll see you all again. Thanks. We'll see you all tomorrow.